It's time now for our next session. Beyond the bid, the rhythm of market flow. Liquidity flows like a symphony, shaped by an array of dynamic forces. As traders tune into the subtle harmonies of high-frequency trading and emerging technologies, the potential for innovation becomes palpable. This session will explore the new strategies that will arise as the market's tempo shifts and the transformative nodes that define the future of liquidity. Our panelists are Prakash Bhudia, Head of Product and Growth, DERIV; Peter Plester, Head of B2B Sales, Exness; John Murillo, Chief Dealing Officer at B2 Broker; Andreas Kapsos, CEO, Match Prime Liquidity; and our moderator for this session is Mohammad Isbeer, Global Head of Brokerage, Sales, Equiti Capital. Welcome.
Thank you so much, and thank you all for attending. And we thank IFX Expo for always arranging this at the beginning of the year. You know, we're all excited to be back to business. This panel is going to be mainly talking about liquidity. We're going to focus on topics, trends, strategies about liquidity. Our panelists have a wealth of experience, so we're going to try and give you as much scope and insights into the world of liquidity. And hopefully you guys can take advantage of this session and take the benefits. I'm going to give all my fellow panelists maybe 30 seconds to introduce yourselves, and then we can start with the topics of today. Please.
Hi everyone. My name is Prakash. I head product and growth at DERIV. We're a multi-asset broker with a presence, offices in over 20 countries, and I'm glad to be here. Thank you.
Hello, my name is Peter Plester. I'm the head of B2B Sales, institutional business for Exness, which is, I think, considered the world's largest retail broker and does several $1 trillion a month in turnover.
Hello, everyone. John Murillo, Chief Dealing Officer at B2 Broker. We're a technology and liquidity provider.
Nice to see the gentlemen. I am Andreas Kapsos, the CEO of Match Prime. I want to wish everyone a happy, healthy, and successful year. I am the CEO, obviously, of a regulated broker, and I'm happy to be here. It's nice to catch up again, guys.
The stage is too big today. I feel like I need to shout to get to you, Andreas. I'm used to you next to me. All right, so we'll start with we're talking about the current state of liquidity in the last maybe 5 to 10 years. What are the changes that happened in the market? You know, innovation, AI, there's a lot of buzzwords, high-frequency tradings that has affected liquidity provisions in the market. How do you see and how do you view the current liquidity state in the market nowadays? Before we start talking about the future and the strategies, but how do you view it as of today with all the changes that happen with technology, maybe regulation, maybe political factors? Anyone wants to start? Yeah, Andreas, please.
Yeah, sure. It's nice that we meet each other every year because we get to see the changes as well and how everything evolves. Undoubtedly, every year we have new things that come into play, and it's nice for us to discuss it. I would say regulation for sure is something that engaged, and we have to embrace it, and obviously it affects us because we need to invest in it. There are a lot of regulations that keep coming, and we need to keep up with it, that's for sure. Technology, it's massive. Obviously, that's also something that we take we have to take care of it and have our attention there as well. Also, for sure, what's going on with the events, this geopolitical, the recent things that happen, we need to keep up with it. So yeah, for sure, I would focus on these three chapters mostly.
Prakash, do you want to say?
Yeah, so I agree with all of the points. I can probably give a little bit more detail. So there definitely has been a transformation post the GFC. So we have had a lot of regulation. We've had, for example, Dodd-Frank, MiFID II, and Basel III, and now Basel IV. So this has affected essentially the risk holding of banks, especially with Basel III and capital requirements. It's been a lot more expensive for banks to hold risk, so they're their trading model has had to transform. This has essentially led to a fall in bank liquidity and a rise in non-bank liquidity. So especially in Forex, where the market's been growing steadily over the last 20 years. I think the last survey, it's around 7.5 trillion daily volumes. And we have another survey this year, which I'm sure it's going to show it's spiked even further. So while regulation was the catalyst, technology has definitely been a big part. So that's effectively helped the rise of non-bank players who now account for more than 50% of the liquidity in Forex. So the technological advances we've seen, we've seen essentially multiple liquidity venues. We've seen smart order routing, right? We've seen all of the infrastructure with low latency, etc. So essentially, the Forex market in particular, the trend is up, but I would say liquidity is now a lot more fragmented amongst multiple venues.
True. And the rise of non-bank liquidity providers is a very definitely an evidence of that. And we're going to go also another step further into kind of the fragmentation of liquidity, and we're going to touch specifically on gold. I don't know, John, you had something to add on this topic as well?
Yeah, I think that basically, in order to add on what the gentleman has just mentioned, we got to remember 2015 was a year where we experienced a black swan event. Since then, liquidity has been priced completely different up until that point. And from that point onwards, we've seen a risk premium element when some of the banks are pricing us today. And basically, that is exactly what has led to the non-bank participation increase. We've also seen a lot of high-frequency trading activity in our Forex industry. I think today is the highest percentage in history. In 2024, we have seen the most activity of HFT business coming into this space. So this is what has shaped our industry. In particular, I've been in it for almost 25 years. So I've seen a lot of changes through time. And technology has been key to this change, gradual change. Now there's a lot more companies that facilitate tech for some of these participants that are coming to the space, which it didn't exist before. It was something very fragmented, exclusively towards the banks primarily.
Peter,
I've been in this market for about 30 odd years. I started as a trader on a bank spot desk. And say 20 years ago, so rolling back a little bit longer than you mentioned, it was extremely manual. You'd have a phone, you'd have a voice broker, you'd click in and you'd put your price in, say 5 points wide in 5 million euro dollar. So that was 20 years ago. Everything was manual, you input the deals manually, etc. And it was basically banks and large corporates and central banks that use the foreign exchange market. If you roll on to now, that normal price quote of 5 points wide in 5 million is now 0.2 wide in 20 million. So you're getting much larger size of trades with much compressed spreads. And the democratization of the industry has meant that it's not just banks. Banks are far less involved now in foreign exchange. It's not just large corporates. It's retail traders. It's prop shops. It's all sorts of smaller and more widely spread customers who are using and accessing the market. So tighter spreads, larger sizes, much faster execution, and many millions of endpoints where LPs are now pricing to. Rather than just pricing into the odd ECN or the odd broker, they now have millions of clients who they're pricing in one go.
Thank you. I mean, I think the general theme here is the kind of the leading factor in changing liquidity provisions is the technological advancement. Is more than regulation. It's more than anything else. So I want to try and kind of shed more light on that side. But before we get to that, one thing that we always kind of try and cover in these events is is gold liquidity. And while gold is considered the safe haven of investments, liquidity in gold in specific has been more challenging than everything else. I mean, we even recently, through December, we've seen a disconnect between the physical market or the future market to the spot market that kind of caused prices to kind of go wild. This thing has been happening. Gold is the highest in demand product in the market, but we see liquidity on gold seems to be like I don't want to say the worst, but the kind of the least taken care of. We know that Credit Suisse have withdrawn from the space a couple of maybe years now. It seems like there has not been a replacement to kind of fill that gap. But what do you see gold liquidity turning into, and how can we solve these issues?
So yeah, that's a great question. So I think there's always been structural vulnerabilities with the gold market. The price discovery is basically happens in two main venues, right? The LBMA in London and the COMEX in the US, and essentially you have the relationship between, as something you mentioned already, was the relationship between spot and the futures. So there's definitely times where there's a disconnect between the two. We saw this during COVID as well, where we saw a strong demand for physical gold. However, the futures price kept falling until it sharply snapped back. And then one thing, this December event actually, which you also mentioned, is a similar thing. This disconnect between spot and the futures, so physical and futures, which essentially led to a sudden increase in physical demand, which couldn't be filled. Overnight lending rates spiked up, and essentially we saw this huge crunch and squeeze in liquidity. So one good point, one interesting point is, of course, the rehypothecation and the lending chains within the gold market. So with tighter regulation, it's a lot more tighter in the US, but particularly in the UK, there's still a lot of these kind of opaque lending structures. So just to, for example, give you an example, I could be a bank A, and Mohammed, he deposits 1 ton of gold with me, and I lend it out to Peter for a 1% rate. Peter then lends it out to John. John uses it as collateral with Andreas, and essentially what you have now is you have multiple claims on this 1 ton of gold, and essentially the crunch happens when Mohammed wants his gold back, and then that leads to this chain reaction where liquidity can dry up very, very quickly. So I think this is the main factor, and that's why it happens ever so often. And I think until we solve these kinds of issues, it will keep happening.
Right. Maybe Peter. Maybe if we're in the same kind of theme here, but how do you fix that, or how do you, as a liquidity provider or a prime of prime, protect yourself and protect your clients against events like that? That's very important, because a lot of people were kind of running like headless chickens during this event. A lot of them didn't know what's happening, but prices, circuit breakers were intact. How do you guys, manage these situations?
Well, one of the ways that Exness, I think, differs from many other LPs and brokers is that we don't necessarily base our spreads on the spreads that are available to us in the market. So if other venues and LPs, etc., widen their spreads, we don't necessarily do that, because we look at volatility to calculate our spreads. So even though everyone else may be widening theirs, ours may not widen at the same rate or at the same time. So we use a slightly different baseline to try and work out what our prices should be. Obviously, there is a big disconnect when things like that happen in the market. Gold is not only a physical store of wealth that people use, it's also something that people may sell when they need to get cash quickly. So, if stock markets are falling, you'll find that people will sell gold to get their money to fund their margin positions in stocks, etc. So there's lots of different things at play that may cause, a big jump or fall in the price of gold.
Maybe John, Andreas, you guys want to weigh in? Yeah.
So what we've seen is our experience during December this year, or previous year, a lot of people were not aware of what was taking place. So it took a while to be able to explain to our partners what was the underlying reason behind. As a matter of fact, at the early stages, we had a lot of upset customers. Not many of them have the expertise to know what takes place as an underlying business that we run.
And the risks of it.
And obviously now seeing this is when you realize the importance of maintaining a very healthy risk management approach. And I think, guys, with all honesty here, it's vital that everyone gets familiarized with the context in which we operate. It is important to protect customers and businesses per se. We had situations where fields were not ideal. Obviously, I understand nobody wants to trade during the widespread, and that's a fact of life. We were trying to reject orders if they were beyond filtration. But what we ran into was a different level of complexity, which is people don't understand why you're being rejected. And then that brings a whole new set of challenges, I like to call it. So in my opinion, what is truly important is to communicate with your partners. I've said this in other events we've held. It is important that your LP in particular shares their expertise, shows you how the industry is evolving, not only when there's a situation like this, but before it happens. We all should be a little bit more proactive with our partners because this helps tremendously. We've been, at least in our business, we try consistently to educate our partners or share our knowledge in order to avoid situations like this, which are never going to be comfortable for anyone. It's not a discussion I want to have with anybody, trust me.
For sure not. And Andreas, I want you to weigh in on that as well, but also I want you to also maybe give us an insight of how often do you think this is going to happen? Are they going to find solutions for this? Is it going to be a problem that we're going to look at it in the next couple of weeks? Because like I said, it happened during COVID, happened again now.
I will go a few steps back.
back
I concur 100% with John because this is what we also see, and I'm sure you guys are seeing it as well. There's a lot of concentration in gold right now. And in many occasions, obviously, we have to take some measures. And at the end of the day, our principle is to help the broker, our client, to get the best service. And the best way to do it is communicate. Sometimes when we take action, obviously, we will discuss with them before we take action. But this concentration of gold that everyone has right now, it has to be treated the right way as well. And sometimes this is problematic and something that we need to take action. And it's great that we have the opportunity to mention it here because we would like to explain the clients why, as an LP, we take these actions for this. Sorry, go again with the question, the continuation of the question that you were.
Yeah, so no, I was just just wondering, is this an event that we expect to continue to happen? Is that disconnect going to continue? I understand the value chain you said is exactly what happened in 2008 with the housing crisis, right? It feels like the same thing as the CODs, which is true. I agree with you. That's exactly what's happening. But isn't that a problem kind of worth being solved and being worked on?
Yeah, of course. But I think definitely we've had new regional hubs emerging. Like, for example, the UAE as a gold hub, but cross-border regulation is very difficult to enforce. So while we have this the duopoly between the LBMA and the COMEX, I think we could continue to see instances where customers, traders, they're left confused. They've had these positions on, there's there's a spike, right, and it comes back down again, and they're left wondering, scratching their heads. So what just happened?
Yeah.
So, yeah, I don't think there's any solution in sight just yet.
Okay. I mean, I remember when it happened, so we sent our clients the explanations. Nobody wanted to accept that. But then when you said, no, it's happening to everybody, it's not just our problem, then it became okay. So if it's happening to everybody in the market, people would accept it. The problem is how everybody reacts. Like John said, some people would reject these orders, some of them would slip the orders massively. The biggest problem is with people going into stop outs, for example, and being rejected. That caused some negative balances. I think it's something that we all kind of worth looking at and think about the next time it's coming, because I think it will always happen until we find a solution. It's just how we deal with it when it happens. Let me move away from gold. I think we spend enough time on gold liquidity, and I want to focus a little bit more into the technology side and innovation. And innovation has touched the trading side from the client side. We've got a lot of a massive increase in high frequency trading, AI softwares that is pushing trades to us, the brokers. I guess my question is, how is the liquidity side or the provider side are using also AI and high frequency trading technologies into price discovery, into alpha generation? So one side of the equation is pushing that, which makes the flow become more difficult, become more challenging for price makers. How are we as price providers are adapting these AI tools and these high frequency tools and machine learning and so on in our strategies and pricing? Peter, you want to?
As AI has become more prevalent in the client side strategies, it's also become a bigger part of how liquidity providers create, distribute, and maintain their liquidity and risk controls. So even though it has benefited the end client, the retail client or the corporate sector, the liquidity providers are also using that same AI technology to improve their own price discovery and prediction of where the market's going to go to, which in turn actually ends up allowing, in general, I would say, liquidity providers to tighten spreads. It's a positive thing overall for the market. We've recently narrowed some of our spreads in gold, funnily enough, because of the extra capacity that we've got from using AI and extra IT resources. Yeah. But it does require an awful lot of investment in machinery, in technology, in connectivity, in people, risk controls. So it's a big cost.
Yeah, and well, yeah, I guess you're 100% right. Well, it helps definitely improve pricing also, but it also helps maybe identifying the right price to the right client. I don't know if you guys have any insights into how machine learning and AI models have also been able to kind of help connect the right liquidity to the right clientele. Something about...
It's down to data analysis, really, isn't it? Big data.
Yeah.
So you have certain clients that traded certain patterns, certain types of size of orders or frequency, etc., and you can better fix the price stream to the right client with the right price stream.
I mean, Prakash, you have been quiet in this topic. You're the technical expert in this. So I want to see, maybe it's a lot of buzzwords. Maybe there's a lot of buzzwords about using AI and machine learning and pricing. Is that what you're seeing, or is there actual implementation that you can...
So, I mean, there's definitely going to be a lot of companies using it as buzzwords, and for example, you could have AI execution algorithms, or even trading strategies, so bots, copy trading, anything which uses AI. So, as investors, as customers, we definitely still want to be very cautious. And not assume, hey, if it's got AI in it, it's gonna perform fantastically. So I think there still needs to be some caution. However, like in terms of the technology, right? So for example, there definitely is a trend, right? So for example, 10 years ago, like high frequency trading firms, like speed was the buzzword. And co-location and low latency infrastructure. and then it moved on to, smart order routing. Then it moved on to execution algorithms. Now it's moved on to predictive and adaptive AI. So at each step of the way, we've started seeing this technology permeating within kind of the retail space. Even very, even normal traders now, there's definitely been a shift in, behavioral expectations. Now, everyone expects great pricing, fast execution, smart order routing, all of these things, no slippage. So it definitely creates that gap between, expectations and where, where we're moving. So there are definitely opportunities for companies and brokers to utilize that space.
Thank you, Prakash. I'm very conscious of the time. We only have 5 minutes left, so I want to try and maybe the last bit that we want to cover is the race to the bottom. With all of these changes, liquidity and all of that, a lot of the prime of primes or liquidity providers out there are just racing to the bottom. With the increased volatility in the FX market, what do you think is the right strategy? Maybe John, we start with you. In your conversations with your liquidity management teams, is it a race to the bottom? Are we focusing on improving spread, or what are you guys thinking when you're strategizing for, let's say, for 2025 when it comes to liquidity topics?
So for us, remember, we cater to the B2B community primarily. So what we try to focus on is how can we deliver a product that is sustainable and, realistically speaking, something that can be utilized instead of synthetically creating a price. We communicate a lot with our banks. We communicate a lot with our partners in order to ensure they understand our flow. I think the secret lies in the communication between us and those makers that we utilize. The more they understand our client base, the more they understand the tag, the better they will be able to price that customer. The race to the bottom, honestly speaking, it has a certain limitation. During high periods of volatility, you're not going to see that. That doesn't exist. Look at where you're being priced on gold today. I mean, everybody was looking at gold. Last panel we had back in 2024, we were seeing a compression sometimes down to 4-5 cents. This doesn't exist right now. So realism has to come in. We all have to be conscious of the environment that we're trading in and the geopolitical consequences of some of the latest situations we've seen globally. We are all interconnected. I believe AI is a tremendous tool if you can train it correctly. As a tech company as well, we spend a great deal of time on trying to improve our AI capabilities. We try to utilize that information, we try to analyze that data and share it with our partners, our banks, our providers, so that they can price our customers to the best of their abilities. Yeah. But there has to be a dialogue.
Yeah. Andreas, maybe you want to also weigh on that? The race to the bottom. I know we hate this. We speak about it every time, but with the increased volatility.
Yeah, I would stick to communication and adaptation of this. Yeah. Like the most important thing is to understand what the needs are, adapt it based on what you want to offer. And then that's what we do now. I mean, we're trying to tailor-made to our guys, that we get the communication with them, they come to us, and then we adapt to it. Now, the AI and obviously these things which we invest highly, everyone invests highly in this, it has to be utilized correctly. As Prakash said as well, you have it, you need to know how to utilize it as well. So for me, that it was going to be a mark, let's say, the difference between everything that we spoke about. I won't take much of your time.
We still have 2 minutes, so I'm going to allow if anyone from the visitors would like to have any questions. Anyone? It doesn't seem like we have anything here. All right. So I think, that brings our panel to an end. I would like to thank everyone on this panel. It has been amazing insights for everyone. And thank you all for joining. And thank you, IFX, for hosting us. I appreciate it.
Thank you.
Thank you.